Hello, this is Dr. Paul Cottrell, and I'm going to be going over the market in this video, but I'm going to be doing a series of videos uh, broken apart on different topics. Some of it will be able to stay on YouTube, some of it will not. So please subscribe to all my channels. I have 3 YouTube channels. All the links are in the description of each of the videos, so please subscribe. And then the other 3 channels are Bitchute, Rumble, and Brighteon. So you can find my work there. I am heavily censored, so as you know, they don't like me talking about certain things, even though I've been proven right 99.9% of the time. But on this video, we're going to be talking about the market. And please subscribe to my Patreon account so you can get also updates about my news coverage on different topics, but specifically the market updates. All right. So we had a very eventful week this week in the United States, and next week will be actually an eventful week for the Europeans. So we have central banks that adjust interest rates. We call it the Fed rate, all right? So we had a Fed meeting on Wednesday of this week, and the Federal Reserve decided to pause. So when you're a central bank chairman or the board at the central bank, you look at different telemetry from the market, such as jobless claims, such as inflation, such as price in manufacturing numbers in terms of inflation, energy costs, the other dynamics that are tied to the economy, bond yields. So, you're looking at all this different type of telemetry, and they release these books periodically called the beige book, right? So individual would understand why they reached their decision. All right. So we had this event that took place on Wednesday where Chairman Powell decided, and the board at the Federal Reserve decided to pause. Now, what that means is that they're not raising the federal funds rate. So, as we know, the Federal Reserve has been at zero bound for a long time, going all the way back to the Lehman days. And they've been trying to unravel the whole problem that we had with Lehman. All right, for this unraveling has been taking a series of years. And once inflation started to take hold, all right, well, before the inflation issue, they were trying to taper the bond purchases post Lehman, right? And when they were doing that, they were trying to bring down that balance sheet slowly, right? But what happened after COVID, or really during COVID, there was this increase in inflation, right? And the famous Yellen announcement when she was being asked by a committee in Congress about inflation, she was saying that it was transitory. Well, the reality of the situation is that it wasn't transitory, and we had a serious bout of inflation that needed to be taken care of. This is the reason why the Federal Reserve is raising rates. Now, our Federal Reserve, our central bank, has a dual mandate. That dual mandate is full employment and controlling of inflation, of price stability. That's what they call it. While the other central banks, such as the ECB, the European Central Bank, is not dual, and it's primarily price stability. I think there is wisdom in the dual mandate with the Federal Reserve, but it makes their job harder in being able to try to manage monetary policy. Now, some people would say we should abolish the Federal Reserve. The Federal Reserve, needs to go to the gold standard and all this stuff. That's a different debate. What is money kind of debate? What backs it? Is a gold standard deflationary? Could it be deflationary? When countries are 100% backed on a gold system, you could cause actually instability in your currency, especially if there are countries that are trying to convert their dollars to gold, and then there's a gold run from the bank. This was what was happening during the Nixon administration. So, there's a lot of complexity, but we're on a fiat currency, and the Federal Reserve adjusts interest rates accordingly based on this dual mandate. Well, the Federal Reserve has been raising the interest rates since this inflationary problem that we've been having recently, in the last 2 years or so. But it really took hold in the last 12 months. And the data is showing that, yes, we still have an increase in prices. Certain items are going down, but on average, the prices are going up, and they're going up above the 2% target that the Federal Reserve has. They have and it's bound, but they're trying to, 2% increase year over year. It's higher than that, so it's a problem. It's lower than what has been in previous periods. So the inflation is starting to peter off. The velocity of inflation is going down, but it's still positive. Prices aren't going to go down, just the rate of inflation is slowing down. So the Federal Reserve is seeing that, and they're going, well, okay, we should pause and see what happens. In addition, there's a lot, because of this problem that we have with the debt ceiling in the United States, there's a lot of issuance of bonds that is happening, that the United States government needs to raise money to pay for all these services and all this spending that has been approved by Congress, in the tune of about $1 trillion. So when you have that flood of individuals purchasing bonds, it may cause problems with liquidity for the equity market. So if the Federal Reserve raised rates, which they didn't in the last meeting on Wednesday, but if the Federal Reserve raised rates, then what that would mean is that the bond prices would be higher. The cost of, let me rephrase that. The interest rate on the bond would be higher, right? Bonds can be priced two ways: dollar value or interest rate. So if the Federal Reserve raised rates, then on average, bonds typically would trade higher than the previous rate setting, right? There's some nuances and complexity in terms of demand for those bonds and the rating of those bonds, but generically speaking, if rates go up from the Federal Reserve, then bond yields will also go up. That would mean that the actual price of the bond would go down. So I think part of the reason why they went with pause was for two reasons, maybe three. One is that the inflation rate is slowing down, but it's still positive, and it's still above the 2%. So the velocity of it is starting to decrease, but it's still above the 2% target, so it's still a problem. So they pause because they're seeing a little bit of a slowdown in the inflation rate, and maybe it will go down further, slow down even further without another rate increase. The other reason I think is that they've raised the rates at a fast clip, the fastest since '81 during Volcker, when he was running the Federal Reserve as chairman, that it's caused some disruption within the banking community, especially when they need funds and that they have to sell funds, and those funds are in treasuries and they're marked to market when they do the sell, and it starts to show that there's a loss on that particular bond because they bought that bond at a much lower interest rate regime, which would mean that the price of the bond was higher when they bought it, but when they're selling it to raise funds, they show a loss in a lot of cases, and it causes a disruption. And this is part of the reason why the SVB happened. SVB collapsed, well, because they had some members, some of their clients starting to run down their cash flows because a lot of them were startups. They were running down their cash flows. So the bank was losing deposits, and it would mismanage its portfolio as the interest rates were starting to go up. So I think that the Federal Reserve they wanted to give a little bit of a breather for the banks, just in case they need to raise interest rates. So people are calling it a skip or a pause, but there is some thought that this is not going to last and that there's going to probably need to be another interest rate hike. So that's a little bit of the background. This thing goes all the way back to Lehman, when we went to zero bound, and now the Federal Reserve is trying to get some buoyancy in the interest rate market to not make the same mistake the BOJ made when they had their big collapse in the early 90s and never were able to get out of zero bound. So I think there's some wisdom to it, but it also causes havoc in the bond market. It causes havoc in the mortgage market, and it causes havoc in the debt market, especially people are carrying debt on credit cards, or they need to refinance because they have a variable mortgage rate. So so it causes some disruption. But overall, the economy will be better when we get past this problem. But we don't get past this problem until we actually have the recession. So there's a few things that have to happen. We had the pre-Lehman problem that took place, or not, well, yeah, subprime borrowers and mortgage-backed security blow up. All right, so that was all building up. Then Lehman happens, and then there's the big quantitative easing and zero bound interest rates that lasted for a long time. And then there was the tapering that caused problems in the market. And then now with the inflationary problem that we had just out of this crisis, because of a lot of problems with supply chain disruption and all this, that the inflation started to go up. pent up demand. And so to prevent this inflationary spiral, we have to raise rates. So there's some good wisdom in what's happening, but you won't feel the wisdom of this until after the recession that happens. So right now we are not in a recession. We still have above normal rate employment. Full employment rate is usually around 5%. All right, that's the basic economic theory. Running at 3 to 4% is a little hot, especially when you have an inflationary conditions that are taking place in goods and services. So the Federal Reserve needs to be taking a stance and saying, okay, we're going to raise rates. And what will happen is that they may need to raise rates again to try to get that recession. They're trying to basically engineer a recession. It hasn't happened yet, which is surprising. Most of Wall Street is surprised that it hasn't happened. All right, so I'm gonna be talking a little bit about the S&P 500, but the bottom line is this: that we are at a pause right now, and now the ECB next week is going to announce, and it looks like they're going to raise rates. So there's going to be a disconnect between the Federal Reserve and other central banks. My understanding, as of this recording, the BOJ is going to go on a pause. So there's going to be some disruption in the currency markets a little bit, and this is going to affect the bonds, the energy, and the equity markets. So let me give you just an idea of where we're at right now in terms of the equity market. So the S&P, what you really want to look at is the S&P 500. All right, and on this chart here is the S&P 500. Right here is when we had the crisis back in 2020 in March, and then the wall of worrying, right? the big climb up. All right, and during this period of time, we were starting to get recessionary conditions. Then we had a bear market. All right, so the market started selling down. So the S&P 500 topped off at about 4,790, roughly. All right. Actually, I'm looking at SPY here, not the actual S&P 500, because SPY is the actual ETF to buy the S&P 500. But so for the SPY, it was 479.98, and then it dropped down to approximately 347. All right, and then it started to move up. Now, on previous videos, the ones that have subscribed to my Brighteon, all right, they know that I've been talking about a floor and a ceiling for the S&P 500. We bottomed out of this bear market back in September of this year, of last year, September of last year, roughly. All right, and we have been ticking up with volatility ever since September of last year. Now, the floor is based on two Fibonacci's, one from 2015 correction all the way to the top of the S&P 500, and another one from the COVID crisis to the top of the S&P 500. There are two Fibonacci's that kind of line up together when it comes to the retracement levels. So the 50% retracement level for the 2015 fib sequence, right, is around 330 or 3,030, looking at it at the S&P 500, so just 5. All right, that's a major floor level, which was not tested during this bear market. It tested the 50% retracement of the crisis, the COVID crisis. All right. It hit that, it tested it and bounced up. That's a major bull signal. All right. But when this is happening, you don't know if it's going to hold. So I said in these prior videos that the floor of this is the 50% retracement, the 50% retracement of the Fibonacci of COVID, or the fib sequence from 2015. All right, so it's either 330 or 347 was the basic floor, and that a major ceiling resistant point was the 23% retracement from the 2015 fib sequence. That ends up being at approximately 408. Okay, 408. We broke that. We tested that multiple times. We tested that 1, 2, and then bounced on it for a while, and then broke it recently this year. So we broke a major ceiling point, and because we didn't bounce back down off of that ceiling point, and it started to rally set for several days, and now we're at 422. We're going to retest the S&P 500 high this year. So that's a bullish signal, and this is all happening when the street was thinking that the Federal Reserve was going to pause. Okay, so the equity market, all right, is going, if we're looking at it from a trader perspective and not an economics perspective, just a trader perspective, if the Federal Reserve is pausing, that's as if they were easing. All right, and an easing of the interest rates, or the Fed funds rate, easing the policy is going to be very bullish for the equity market in the long term. We are setting up for the next big bull market. Now, what's going to happen here is we're going to retest this high, all right, depending on where the inflation rate is, right? If they have to raise rates, then there's going to be some tumult in the market, and it will bounce down and then come back up. But I would still be very bullish. It would be a short-term kind of correction before we break. If the inflation is controlled and it's starting to continue to, the velocity continues to slow down and ideally reach the 2%, then the Federal Reserve will not change policy and will maintain a pause, and the market will continue to decline. So if inflation in the next board meeting for the Federal Reserve shows hot, then they're going to raise rates, and it's going to be negative for the market short term. If the inflation is controlled, or ideally going down, then the market will continue to rally. So breaking that ceiling, that 23% retracement on both the fib sequence from 2015 and the fib sequence from COVID is a major bullish sign for equities long term. And when I say long term, I'm not talking 10 years. I'm talking, you know, in traders on the long term, you know, 1 year from now, right? But it will also be very bullish long term in terms of, you know, five years out. But we're seeing the play now. What did I do? All right, so I have a passive account and I have a very, very active account. The passive account, I deployed about 50% of the cash that was on the sidelines during this mean reversion upward. All right, I'm probably going to put in an additional amount tonight. All right, because of this big bullish sign that broke like the last 3-4 days for the S&P 500. So keep that in mind. Now, if we look at the VIX, which is a volatility index of the S&P 500, the VIX is low. It's in the 14s. It was as low as 13 something just a day ago. All right, so volatility is very low. Another bullish sign. Now, in terms of oil is trading at, as of this recording, at about 70. It's been bouncing around 73 to 68, right? So as long as oil doesn't break 80, it's not going to be inflationary. So that's also a very good sign that the Federal Reserve will not have to tighten and it will be bullish for the equities. And as the Federal Reserve is pausing, then in terms of rates on bonds, they'll kind of, they won't have as much volatility in it. Because again, remember what I said, as the Federal Reserve raises the federal funds rate, it has a tendency to increase the bond yield and lower the price of the bond. So there's going to be less stress as long as oil stays relatively low, in the low 70s to mid 60s range, or even lower, then it's not going to be inflationary, and we're going to have that major component isn't going to drive the federal funds rate up higher. So it will kind of stabilize the problems that some of the banks were having, stabilize the market. And it goes back to what I'm saying. The federal government, the United States federal government, has to fund its operations through bond issuance. And if they're funding their operations and bond issuance with a higher interest rate, a higher bond yield, then it's going to cost them more to actually service their debt. So they don't want the Federal Reserve to raise rates. So I think there's a little bit of, play that's going on between the Federal Reserve and the Treasury Department issuing bonds. Now, currency. Because I take a look at oil, currency, the VIX, S&P 500, and with that, I like looking at the euro and the Japanese yen. The Japanese yen is trading at 140. All right. Now, if we look at the day chart, the yen has been weakening. The dollar has been strengthening. All right. This has been happening for primarily most of the year. Okay. There was a little bit of a mean reversion around March, and then it went back to weakening. The yen was weakening relative to USD. Now, as there's a complexity with the yen, it is a risk indicator. So even if the Federal Reserve isn't raising rates and there is some worry in the market for some reason, usually the yen will strengthen and the dollar will weaken. It's like a risk indicator, all right, for the international markets, right, and the flow of money international. So independent of what the Federal Reserve does, if there's worry in the market, then the yen will strengthen and the dollar will weaken in relative terms. Now, the dollar index is more heavily weighted with the euro than the yen, but the yen is more of a risk indicator. If the yen is weakening, that is risk on for equities, usually. All right. Now, if the Federal Reserve is raising rates, in this case, the Federal Reserve was raising rates, then what's happening here, even in kind of, if you look at when the yen was when the yen was weakening, going all the way back to January of mid-January of this year. If you look at mid-January of this year, there was a lot of concern in the market, but yet there was a trend upward, but volatility. All right. So you can kind of see that in March, the yen started to strengthen all the way to mid-March. And in the equity market, in the beginning of March, the yen started strengthening. And as it was strengthening, there was larger candles and going down for the equity market. So this right here is actually, as the yen was strengthening, we actually see the downward trend that was going on in the equity market. But after that, the equity started to go up, and voila, yen started to weaken. And that was also happening with the Federal Reserve still tightening. All right. So there's a complexity here. But when you're looking at the yen in terms of just risk indicator, as like for a trader, if yen is strengthening, it's not usually good for equities. If yen is weakening, it's good for equities. All right. But if you're looking at it from an economics point of view, and trading and economics can be two different beasts sometimes, and sometimes they're discoherent. The Federal Reserve was raising rates. Well, when you're raising rates, it actually strengthens the dollar, because by raising rates, you are extinguishing the money supply. When you are lowering rates, you are increasing the money supply. All right. So the dynamic with that is that one way to do it, there's several ways, but one way to do it is that the Federal Reserve can buy or sell bonds. Well, if it's selling bonds to the market, right, then it's bringing in money to the Federal Reserve and extinguishing the money supply that's out there, that's circulating. But if the Federal Reserve wants to, when they sell the bond, they're tight. They're literally that is a tightening process, right? And when they're doing that, interest rates will start to go up. The reason being, there's more supply of bonds and less money, because they're bringing in the money and extinguishing it. If they buy bonds, if the Federal Reserve is buying bonds, they're flooding the market with money. All right. So this is the quantitative easing, quantitative tightening, the process here. So as the Federal Reserve is raising the federal funds rate, it's actually extinguishing cash, and it's trying to contract and trying to slow down the market. Two things are happening. They're trying to increase the unemployment rate to probably around 5 or 6%. And the reason why is because they don't want wages to go up too high, because that's, you know, also tied to inflation, and wages usually are sticky. On top of that, they're trying to control other price inputs that are part of the inflation function. So right now, the yen is substantially weakened. Another bullish signal for equities. Like I said, oil is trading around $70. Another bullish signal, right? If it's trading lower than that, it's going to even be more bullish. If it's trading above 80, then again, you have that inflationary pressure that you have to worry about. And now the euro is trading at on the day chart, the euro is, all right, the euro has been relatively flat. It's been going up and down. So if you look at it, what was going on since the new year, the euro to the USD went up. The euro was weakening. The euro was weakening relative to the USD. The first quarter of the year, and then I'm sorry, let me rephrase that. The euro USD trade was going up the first quarter, and then there was was going up, and then it went back down in March. So it was kind of like a round trip. It went up, it went up, and then went down and bottomed out at around March, the beginning of March, and then started to go back up. And then it went back down last month, and then started to go back up. So it's been cycling. It's been cycling between anywhere from 104 to 1.1. So it's been cycling, you know, so and it probably has to do with, as the Federal Reserve was raising rates, the ECB is raising rates. That's probably why it's happening. Now, let's go back to what I was saying about the decoupling between the ECB and the Federal Reserve. The Federal Reserve did not raise rates this time. The ECB is projected to raise rates. So that would mean that as they're raising rates, their currency in relative terms should actually, in theory, in economic theory, should actually appreciate relative to the USD, because the Federal Reserve is being accommodative by taking a pause, while the ECB relative to the currency, they're tightening, right? They're raising their rate, and that is remember, that's extinguishing currency, and by extinguishing currency, the actual value of it goes up. But again, there's some behavioral things that's going on. So I suspect that the euro will strengthen to the USD when the ECB actually raises rates. But again, they only have a single mandate, and that's just tied to inflation. So hopefully you get an idea where this is going. Recap. Very, very bullish sign with the Fibonacci's on the S&P 500. So for stocks, for the near term, the VIX is very low unless some event happens that is unforeseen. There's low volatility, so that's also bullish for equities. And typically what happens is when equities go up, bonds will trade lower, right? So And then oil is trading in the range of around 73 to about 68. As long as it's trading lower than 80, it's not going to be inflationary. So that's also a very bullish sign for equities. So hopefully you've learned something about this. We did break the support levels, not support levels, the resistance levels. We did break the resistance levels on the Fibonacci from 2015 and the 2019 crisis. And because we broke that 23% retracement from the all-time high in the S&P 500, we are in a very buy signal when you're looking at it from a trader perspective. So, but again, economics is kind of a arcane art, arcane science maybe, and trading and investing is more behavioral, and sometimes they are discoherent. So hopefully you learned something. Thank you for listening, and please subscribe to all my channels. I have 3 YouTube channels. On all the descriptions are in this video and all the videos. Please click the link to those YouTube channels and subscribe. Also subscribe to my Brighteon Channel, Rumble, and Bitchute channel. I'm having a hard time people to migrate to all these different channels. There's censorship, and the only way you're going to be able to see my work is if you can go to a multitude of different channels. So please subscribe to all those channels, just in case if one of those goes down because of censorship. In addition, to help support my coverage, please subscribe to my Patreon account, and that will help me to do these kinds of videos for you. In addition, please go to my store, the-studio-reykjavik.com, and purchase the products that I offer to help you with going down a anti-aging protocol road. You know, I have a lot of different products. I have nano silver liquids and gels, soaps and lozenges that will help to neutralize pathogens. I have C60, that's a very strong antioxidant. And when you take antioxidants, you can slow down aging. I have a plethora of supplements and toothpaste and multivitamins that will do wonders for your health. I have B complex, I have multivitamins, I have zinc, magnesium, D3, lignans, digestive enzymes, collagen, turmeric, ashwagandha, vitamin C, resveratrol. I have a lot of stuff there that will help with your anti-aging protocol and to get healthy and to be more vibrant. In addition, I also have a citrus deodorant made from all natural ingredients and a peppermint and tea tree deodorant also made by all natural ingredients. So please go to the store, support my work, get healthy, follow my protocols. I take liquid nano silver every day. I use the nano gel every day on my skin. I take the collagen. The C60, it's a very strong antioxidant. I take a teaspoon of that every day. And, you know, if you're just starting off, you know, ashwagandha is really good for controlling blood glucose levels, and turmeric is great to bring down that inflammatory response. That's a good start. Obviously, you need your B, you know, complex. You need multivitamins and, you know, vitamin C, the resveratrol, which is great for getting rid of senescent cells, and it's also a good antioxidant. It's synergistic with C60. So get the supplements that you need. The probiotics. I have 2 different types of probiotics. One's in a capsule, and the other one is in a powder. Right? Get healthy. Follow the protocol, and you'll do wonders. If you don't know what to get, try an anti-aging box that I've curated. Right? at different price points. There's like beginners and advanced and deluxe and all these different boxes that I have. But take a look at them and you'll be able to see what you need to follow these different protocols, these health protocols. So thank you for listening. Thank you for supporting the channel. Please go to my store, the-studio-reykjavik.com. All the links are in the description of every video I do. Thank you for listening and have a nice day.